Income taxes. The objectives of accounting for income taxes are to recognize the amount of taxes currently payable or refundable, deferred tax liabilities and assets for the future tax consequences of events that have been recognized in the financial statements or tax returns. To achieve these objectives, an entity uses the assets and liability approach to account for income taxes currently payable or deductible and deferred taxes. Basic definitions. Income tax expense or benefit is the sum of current tax expense or benefit and deferred tax expense or benefit. Current tax expense or benefit is the amount of taxes paid for payable or refundable for the year as determined by applying the enacted tax law to the taxable income or excess of deductions over revenues for that year. This amount is an income tax payable for the period. The approach is sometimes called income tax basis accounting, which is an other comprehensive basis of accounting, not GAAP. Non-taxable revenues and non-deductible expenses are included in the income statement. Taxable income is the income calculated under the tax code. Taxable income equals pre-tax accounting income adjusted for permanent and temporary tax differences. Deferred tax expense or benefit is a net change during the year in an entity's deferred tax amounts. A deferred tax liability or asset records the deferred tax consequences of taxable or deductible temporary differences. A deferred tax liability or asset is recognized for the estimated future tax effects or temporary differences and carryforwards. A deferred tax amount is measured using the enacted tax rates expected to apply when the liability or assets is expected to be settled or realized. Inter-period tax allocation. Inter-period tax allocation is required. Income tax expense benefit is allocated to continuing operations, discontinued operations, other comprehensive income, items debited or credited directly to equity. Inter-period tax allocation is needed because items included in determining taxable income may be presented in different sections of the income statement. A tax or tax benefit should be shown in the same section as the related income or expenses. Inter-period tax allocation amounts. If the entity's income tax return for a year includes the tax consequences of most items recognized in the financial statements for the same year, significant exceptions may exist because of differences between the GAAP basis of accounting and the income tax basis of calculating taxable income. Temporary differences result when the GAAP basis and the tax basis of an asset or liability differ. Differences in the two bases arise when the items of income and expense are recognized in different periods under GAAP and under the tax code. The effect is that a taxable or deductible amount will occur in future years when the asset is recovered or the liability is settled. Tax consequences of some items may be recognized in tax returns for a year different from that in which their financial statements effects are recognized. The following are examples. Different depreciation method may be used for tax purposes and in the financial statements. Accelerated depreciation is allowed for tax purposes for certain assets, but they may be depreciated using straight line method on the financial statements. Expenses for warranty liability are recognized in the financial statements on the date of the sale under the accrual method of accounting. For tax purposes, warranty expenses are recognized under the cash basis when the actual payments or warranty costs are made. Credit loss expense is recognized in the financial statements under the allowance method in accordance with the income statement or balance sheet approach. For tax purposes, credit loss expense is recognized when the debts are determined to be uncollectible using the direct write-off method or special allowance method subject to reasonableness limitation. A permanent difference is an event that is recognized either in the pre-tax financial income or in taxable income, but never in both. It does not result in a deferred tax amount. The following are examples. Payments of fines or penalties are recognized as an expense in the financial statements, but are never deducted in the tax return. Interest on state municipal bonds is recognized as income in the financial statements, but not in the taxable income for tax purposes. When tax consequences and financial statements effects differ, income tax is currently payable or refundable, also may differ from income tax expense or benefit. The accounting for these differences is inter-period tax allocation. Deferred taxes. Deferred tax liabilities and assets result from temporary differences, not permanent differences. Deferred tax liabilities. Tax temporary differences result in future taxable amounts and are deferred tax liabilities. Deferred tax liabilities arise when revenues or gains are recognized under GAAP before they are included in taxable income. An example is income recognized under the equity method for financial statement purposes and at the time of distribution in taxable income. Deferred tax liabilities also result when expenses or losses are deductible for tax purposes before they are recognized under GAAP. An example is accelerated tax depreciation of property. Deferred tax liability equal future taxable amount multiplied with tax rate. Deferred tax assets. Deductible temporary differences result in future deductible amounts and deferred tax assets. Deferred tax assets result when revenues or gains are included in taxable income before they are recognized under GAAP. Examples are unearned revenues such as rent and subscriptions received in advance. Rent or subscriptions received in advance are taxable when received, but are only reported for accounting purposes when the revenue has been owed. Deferred tax assets also result when expenses or losses are recognized under GAAP before they are deductible for tax purposes. Examples are credit loss expense recognized under the allowance method and warranty course. Deferred tax assets equal future deductible amount multiplied with tax rate. Calculating tax expense or benefit. Income tax expense or benefit reported on the income statements is the sum of the current component and the deferred component. Current tax expense or benefit is the amount of taxes paid or payable or refundable for the year based on the enacted tax law. Current tax expense or benefit equal taxable income or excess of deductions over revenue multiplied with tax rate. Deferred tax expense or benefit is a net change during the year in an entity's deferred tax amounts. Changes in deferred tax liability balances add or subtract changes in deferred tax assets balances.